Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Let's turn to retail. Lululemon upping its full-year outlook thanks to strong sales in international markets. The company seeing flat sales in the United States last quarter, but a 39% rise in China. Sucharita Kodali of Forrester saying athletic gear still seems to be strong. The affluent, fitness-focused consumer is still spending. Sucharita joins us now for more. Sucharita, welcome to the program. What is Lulu getting right this time?
Well, I think a lot of this is just the entire sector is doing really, really well. When you look at the numbers for other companies that are selling similar products, whether it's On Running or you're looking at Dick's Sporting Goods, they are doing incredibly well as well. So the shopper is just spending in this category. Lulu has been performing incredibly well for years. And this year it was more just because of some lower guidance that some of the numbers are soft. And it's been underperforming the market. But the story is that their overall top line has been strong. And some of these international sales, as you point out, have been a big driver in its success, which is interesting because that is perhaps one of the areas where it may have some softness in the future if tariffs actually become more prevalent.
Well, Sucharita, it's interesting also because so many have struggled in international markets, particularly in China. What underpins that success that they're having?
Yeah, it could. A lot of it is likely just newness to the Chinese consumer. Chinese consumers, like many consumers around the world, are often interested in purchasing whatever is on trend, whatever is new. They're as influenced by social media as consumers anywhere in the world. And I think that Lulu has had a strong formula for success, and that has been an enormous driver. In the U.S., it's interesting that some of these numbers were softer in Q3, but I expect in the next quarter, particularly as that will be the holiday numbers, it should be even stronger.
Well, Sucharita, I might be revealing too much about my social media habits, but all over TikTok, Instagram, I see all these influencers saying, hey, these pair of sweatpants from Lululemon, you can get the exact same thing on Amazon for a third of the cost. What is the bigger threat to Lulu? Is it the Alo Yoga, the Vioris, the high ends of the world, or is it Amazon and fast fashion?
Well, that's a great question because the biggest threat to Lulu is likely that competition where they could become the new middle. And that's absolutely where they don't want to be. They need to continue preserving their premium positioning. They need to be very, very careful about promotions and discounting because you're absolutely right. There are competitive threats that are at the high end and there are absolutely the knockoffs at the low end. And you don't want to be either. You need to make sure that every part of the brand, the logo, all of those elements are preserved and protected and that discounting doesn't become too prevalent in its business model.
How are they on that front, on inventories and fighting off discounting, Sucharita? Are they doing a good job there to fend off falling into the middle?
It seems at the moment that they are fairly strong. This is a company that seems to have pricing power and seems to be able to get away with minimal discounting. You don't necessarily see the huge Cyber Week and Black Friday promotions that other brands and the deep discounts that other brands are forced to reckon with. They did have an inventory situation earlier in the year. It seems like it has stabilized a bit. So it appears to have they seem to be in a better position going into Q4. And I expect that will also carry through 2025.
Sucharita, when it comes to the international business, analysts were noting that it was the leggings category that was seen as strength for the first time in a while. But I thought the Lulu problem was the fact that they were leaning too much into tight-fitting clothing and had to go into a more baggy look. Which one is it?
Well, a lot of this is also very dependent on regional preferences, too. So The challenges are that certainly that they're going to have to figure out from their merchandising standpoint, from their product development standpoint, what is appropriate in which markets where, which colors, which styles are going to resonate more with shoppers. A lot of that is going to be influenced by social media. Much of it is going to be influenced by even store associates in stores. So a lot of this is going to fluctuate. That is one of the challenges of being a fashion retailer. But also what Lulu has is the ability to actually shape what shoppers want by what it has in the store and what it's positioning as what is on trend at any given moment. When you look at the U.S. and also consumers around the world, which do you see right now in terms of who is the most picky? Where's the pickiest consumer? That's a great question because consumers everywhere are pretty picky. And this is one of the things that we are certainly seeing is that certainly at the low end, consumers are incredibly fickle because they're the most economically distressed. But even at the high end, we see a lot of fickleness because those consumers, while they're still flush with cash, they have so much choice. And we see that in some of those U.S. numbers. And that's absolutely an issue that every business that is trying to attract higher end customers has to face.
Sucharita, good to catch up, as always. Sucharita Kodali there of Forrester Research. I want to cross over to Tom Porcelli of PGIM. Tom joins us now for more. Tom, your first reaction to this one, what jumps out to you?
Yeah, so good to be with you all. Look, I think at the end of the day, this report is pretty consistent with what our view has been, which is to say, the labor backdrop has slowed down quite a bit. I think there are some cracks in the labor backdrop, but the floor is not falling out from beneath us here. I mean, we like to look at something called cyclical hiring, and so basically you just take private jobs, you strip out healthcare. We gained 121,000 jobs this month. I mean, even if we exclude the prior month, which was impacted by all the things that we know at this point, Boeing and the hurricane, you're averaging about 100,000 jobs from a cyclical hiring perspective. So again, our view has been that continued economic expansion will roll into the coming year. But you're going to do it with a labor backdrop that has slowed down. And I think, will remain soft.
Tom, just to be clear, does this change anything when it comes to December cuts, the rhetoric we've heard from Fed officials?
No, Danny, I think you're quite right to ask this question. No, I don't think it changes anything. I think at the end of the day, I think this is a kind of number that will support the Fed cutting rates in December. I think that, looking for, 2 or 3 more cuts in the coming year, I think is completely reasonable. But again, I think it's interesting, right? Because people were really looking for, sort of or hopeful that this report will really bounce back in a more notable way than what we've seen. And it didn't. And I think that really drives home that when you look at all this other labor market data, all this other labor data have really slowed down quite a bit. I mean, if you're waiting for the payroll report to crack, it's too late. I mean, this is one of the most lagging of economic indicators. And as I think we all appreciate now, is revised relentlessly. So I think when we look at some of the leading metrics, it does seem like things are slowing down.
Does that mean that the bigger risk for volatility in this market, for volatility of policy, is next week, CPI, PPI, import prices?
Yeah, Danny, and that's, again, one of the sort of the unfortunate realities, right? I mean, when you think about the things that really drive monetary policy decisions, a lot of them are lagging indicators, like the payroll report, like CPI. So I think you're right. I think that we're probably going to be swung around by some of this data because while this report at 227 is pretty reasonable, I mean, you can't discount that next month you're going to have a low 1 handle. I mean, that's how the data have been rolling. And then, of course, you then build in the revisions. It's like you're not just looking at the current month anymore. You have to look at what the prior month did from a revisions perspective. So, yeah, I do. I think that things actually wind up being pretty volatile in that regard.
If you are just joining us, welcome to the program. You just missed out on the jobs number, 227, a small upside surprise. The median estimate was 220. Unemployment came in at 4.2%. That is the wrong kind of upside surprise. We were looking for 4.1%. Wages coming in just a little bit hotter than expected, in line with the previous month at 0.4%. Joining us now, Mohamed El-Erian of Queen's College, Cambridge. Mohamed, you've had about 7-8 minutes to chew over these numbers. What stands out to you, sir?
Thank you, John. As Jim Bianco pointed out, the challenge for the market and for policy would have been a consistently strong report. This is a somewhat strong report, but not consistently strong. So it is strong on the earnings side. It is strong on the labor participation coming down side, less supply, and it is also strong on a small beat on employment. But the fact that the unemployment rate went up means that the Fed will be comfortable cutting by 25 basis points, means that the market will increase the probability of this happening. So on the policy front, this did not complicate what would have been a messy situation for the reasons that Jim pointed out. On the economy side, John, just a confirmation that the labor market remains solid and that U.S. exceptionalism is set to continue.
Mohamed, it makes the decision easy to cut 25, maybe. Still got to wait for CPI next Wednesday. I wonder, though, if it's still just as hard to signal anything for 2025 in the news conference. What is that exercise going to look like in 2 weeks' time?
So it would be hard for this Fed because this Fed is so reactive, is so data dependent, that it will simply tell us that it will remain data dependent. And I suspect that while the range is going to compress a little bit, you're still going to have quite a wide range in terms of the terminal rate. The Fed always has two options. The option it took in 2021 and got completely wrong, which is to look forward. And now it shied away from that and went to the option of being excessively data dependent. And I suspect they'll stay excessively data dependent. So we're not going to get any strong signals other than we will remain data dependent.
Tom, can I get your opinion on this? What it looks like in December, what the summary of economic projections looks like, what they can project forward, if at all?
Yeah, look, I think Mohamed is quite right. I think, prudence, I think, is demanded right now. Powell's he's in a slightly tricky spot. And I think he's laid the groundwork for that, right? Like you think about his speech at the deal book the other day. I think what he laid out there to me, I think made a lot of sort of practical sense. They're just going to continue to wait and see how the data unfold from here. They're not going to pre-commit. I mean, he's already laid the groundwork for, sort of a skip after the December meeting. I mean, he's been pretty clear on that, not just at the deal book meeting, but during the last presser too. So I think, when I think about the sort of the SEP at large, I mean, look, I don't know that they have to make any wholesale changes here. I mean, the economy is more or less evolving in a similar fashion to what they have there for 2025. So again, I think it would be in their best interest to not really make any wholesale changes. This is a nipping and tucking outcome, I think.
Well, when it comes to the data, and we're still waiting on CPI next week, Mohamed, last time you were on for the jobs report, you said inflation is not dead. What kind of number could we see that could potentially change the Fed's thinking at this upcoming meeting?
And you heard from the chair saying that inflation has been more stubborn than he and the Fed expected. Look, we're going to see inflation stuck in the 2.5% to 3% range for the Fed's preferred measure, the core measure. And the Fed's going to have to make a decision. My gut feeling is that it will run with this number there, promising us 2% down the road. And I suspect we'll see 75 basis points of cuts still, but they're going to be spread out. Like you just heard, it's going to be cut, pause, or skip, and then cut, and then we're going to have a huge conversation. Was this a hawkish skip? Was it a dovish skip? So we're gonna go to the third differential now, because we lack proper policy guidance.
Mohamed, you went there. So what kind of skip or cut are you expecting? A dovish cut, a hawkish cut? What are you looking for?
Look, no one is going to predict this when you know that the reaction function of the Fed is backward looking, because it will depend on the latest number, unfortunately.
And CPI drops next Wednesday. Bond yields right now are lower by about 4 basis points on a 2-year. On a 10-year, we're down by about 2 basis points. Equity futures still higher on a session on the S&P 500 by close to 0.2%. The numbers dropped about 12 minutes ago. I'm going to cross back over to Mike McKee for a little bit more. Mike, you went through what was behind that uptick in unemployment, the snapback that we didn't really get. I think a lot of people in the market were looking for a big snapback in payrolls. Where did we get some growth and where did we miss out?
Well, what's really interesting is we saw a decline in retail sales hiring, minus 28,000 in the month of November when people are usually staffing up, which leads you to believe that there may be some seasonal effects to this. The seasonal adjustment factors may be holding down the number of jobs created a little bit. Trade and transportation jobs also down 23,000, and that's usually when we're seeing the additional UPS and FedEx drivers and that sort of thing. So a little bit of a surprise there. We did see manufacturing rebound with 34,000 jobs, so good news there. Construction only 10,000, and we're looking at the government hiring is one of the highest at 33,000, but almost all that was state and local. Federal government lost 2,000 jobs, and our old friend leisure and hospitality did rebound 53,000 jobs total, and about 28,000 of those were in the restaurant business, so people getting jobs there. And then I do want to point out the three-digit unemployment rates, 4.246 for November. So basically just below a 4.3% reading. Would have gotten the Fed's attention, if not worried them. Remember, they forecast in September 4.4% by the end of the year.
Good catch, Mike. As we count you down to the opening bell in about 46 minutes' time, you'll see the outperformance on the small caps. The Russell up by something like 0.8% at the moment on the screen, up by 0.81 off the back of this move lower at the front end of the yield curve, with yields down something like 4 basis points. Jeff Rosenberg of BlackRock joins us now to get his input on the program. Jeff, welcome to the program. The panel so far suggesting the door is still pretty much wide open for a 25 basis point reduction. Is that your sense of things as well for 2 weeks' time?
Yeah, I think that's the read. This is clearly just reiterating a gradual slowing in the labor markets. As Mike just pointed out, to all three digits, that unemployment rate kind of helps the Fed come in December to cut. The market was already pricing 70% of an outlook for that. And I think the bond market reaction, the initial reaction, is just kind of increasing that on the kind of gradual labor market slowdown. So I think that's very much the read. And as the panel was just discussing, we're going to pivot to this, pause, skip debate and what kind of message that means. But the big debate is over the degree to which cuts have to take place in 2025 and the disconnect between financial conditions, which are going to be easier after today, and the degree of restrictiveness that you still see some of the committee members believe justifies that number of cuts that they're forecasting into 2025.
Jeff, are you arguing then that you need to have a Fed who starts paying attention more to these financial conditions? That conversation has kind of gone by the wayside. Are they going to have to rethink cuts because of what this market is doing?
It's gone by the wayside, but then there was a little bit of acknowledgement of it in Powell kind of acknowledging, we cut 50 and then the data revised. The whole issue is really about the strength of the economy. And as Mohamed rightly points out, this is a very, very data dependent and reactive Fed. And the data that's key here on how restrictive policy is really economic growth. And you don't see economic growth well below potential. You see economic growth above potential. And that's telling you that monetary policy is not as restrictive as they think it is. Now, there's a little bit of a disconnect between whether you're looking at the growth measures or whether you're looking at the labor market. Take out about 100,000 from today's payroll print. That's hurricane and strike payback. The labor markets are moderating. That's the best evidence of the restrictiveness. But outside of that, you really see the impact on financial conditions, animal spirits. This is a very supportive financial conditions environment. And that's how monetary policy transmits. So maybe you don't need to keep pushing into financial conditions, easing by this degree of cuts that they've been signaling.
Well, Mohamed mentioned it earlier about now the third degree. If the door is open for this cut and there's going to be a bias to 25 basis points, then what is the tone and the rhetoric around that? Is it going to be a hawkish cut because they're going into 2025 and there's going to be a lot of change of fiscal policy in Washington?
Well, it's hawkish relative to expectations, right? So 2 weeks ago, 4 weeks ago, the market was expecting, a very aggressive pace of Fed cuts. Now we've priced that out from the markets. And so there's a little bit less of a disconnect between the Fed moderating the pace of cuts into 2025 and market expectations. So that may read hawkish, but if it confirms market expectations, not so problematic. If there's a even greater acknowledgement of that, I think that would be surprising, and that would read hawkish. I think when you get into 2025, it is going to be about understanding this pace of cuts has to slow because the economy and the data doesn't support the amount of restrictiveness that the Fed thinks they currently have.
Another round of Fed speak coming up today, and then obviously we're going into the quiet period. I think they've been quite consistent through the week so far. We've mentioned this quote from Governor Waller in a speech from him earlier this week, cut or skip. This is what he had to say on the neutral rate. There is still some distance to go in reducing the policy rate to neutral. Tom Porcelli over at PGIM, I just want to give you a final word just quickly on the neutral rate. They think they're a long way away from neutral. They think they've got space here, which means they can carry on cutting interest rates. How much distance do you think there is between where we are and where neutral might be?
It depends which Fed official you ask, right? I mean, think about the dispersion in the estimates of what neutral is. I mean, the low end is 2.25, and the upper end is 3.75, right, per the long-term dot, obviously nominal we're talking here. That's 150 basis points of spread. So depending on who you ask, you could be really far away from it. I think what's going to wind up happening, John, is this. So if you look at the Fed's 25 dot, the median is 3.4%. I think what's going to wind up happening is that's going to shift higher, right? And I think to Jeff's right point, I think it'll wind up shifting higher to where the Fed, where the market is, right? The market is pricing in, I think, 370 right now by the end of the year. So you take out one of those 4 cuts that they have priced in for next year. I think it falls in line with what the market is thinking, and I don't think that has to be terribly disruptive.
Tom Porcelli of PGIM. Tom, appreciate your time, sir. Thank you. Mohamed, I want to come back to you on the same question. I think this is an important debate. How we reconcile our differences here between where the market might believe neutral is and what this Federal Reserve is signaling. How do you think we close that gap?
I think we close it by fudging a very key variable to all this is what is the inflation target. John, if your inflation target is 2%, then you should not cut in December. If your inflation target is somewhere between 2.5 and 3, which is justified by all the changes, all the structural long-term changes going on in the economy, then you cut. And we are fudging this. No one wants to talk about this. I don't know if you saw a few Fridays ago in the afternoon, the Fed put out its discussion of the monetary framework coming up and said explicitly, we will not discuss the inflation target. But critical to all this is what de facto inflation target will they run with. My own gut feeling, as I said, John, they're going to run with slightly higher, and that means that ultimately they'll end up somewhere between 3.75 and 4.
Mohamed, what about the argument that they can't abandon what they have now as their inflation target because it's important in setting expectations? It's important not to have people run away and think that we're going to have higher sustained inflation and therefore change consumer habits. Is there any credence to that argument?
I think there is, and I think there's many ways to do it, and people have come up with different ways. My concern is if they truly believe that 2% is somehow given to them, it's not an arbitrary number, and if they try to get there and stick to that inflation target, they will sacrifice the American exceptionalism. That's what I'm worried about. But then at the end of the day, I think they're going to fudge it by saying 2% down the road, and it's just going to be a very long road.
Jeff, do you agree with Mohamed that 2% down the road is going to be very long?
I do, and I think this is a really important debate, and the Fed has had this debate, and I agree with Mohamed. They're not going to announce a change to the inflation target. They're going to stick to the target, Danny, for the reasons you point out. They agree as well. It's very important to expectations, but there's a lot of room for interpretation, and so 2, 2.5, 2.6, 2.7, and I agree with Mohamed that the cut in December of 25 basis points is kind of telling you where they lean on inflation versus growth. I think there's some long-term consequences for that, because if the bond market wakes up to the fact that there's a tolerance for inflation, and the real test is, as long as inflation is gradually moving lower, and even if it's moving sideways, they can kind of play this fudge it game. The real test is what happens if the acceleration in growth, the impact on financial conditions starts to press on inflation. And the one thing we didn't talk a lot about, and it's hard to see here whether the wage number today and the slight uptick is just a mix shift or not, but you haven't really seen the wage numbers kind of conforming to, depends on productivity, the 2% inflation target. The real challenge is going to be, what do they do if inflation starts to go back up? Not predicting that, but that's where you kind of are going to put this 2 versus fudging to 2.5 really to task.
That's the risk for 2025. Jeff Rosenberg of BlackRock. Jeff, thank you, sir. If you are just joining us once again, welcome. 227 is the number. It's an upside surprise against a 220 estimate. Unemployment just creeping a little bit higher. 4.2 and very close to 4.3. The estimate was 4.1%. The takeaway for a lot of people in this market, it leaves the door wide open for an interest rate reduction on December 18th. Still one more data point still to go. CPI next Wednesday. Mohamed El-Erian still with us for some final thoughts. Mohamed, we all noticed that you published the FT column ahead of this conversation this time, and I noticed the content of that piece as well. It's not about whether the US will outperform. It will. It's the extent to which it will diverge from the rest of the world. You noted earlier this week, and I think it's a perfect time just to finish and think about the rest of the global economy. As we get 227 in America and start to complain about whether that's good enough, the rest of the world is struggling. You noted China and a potential Japanification of China's economy. We've noted Europe's inability to govern itself throughout the whole week so far. In a tripolar world, Mohamed, what does 2025 look like?
It's a world of dispersion. John, I've been saying with you for the last few months, the good, the bad, and the ugly of the global economy are to follow. The good is the US, the bad is China, the ugly is Europe. And we've had confirmation of that over the last few weeks. It is a world where there's going to be significant differences in the three systemically important economies. And that's going to play out in the currency market, first and foremost. It also is going to play out in yields, but it will continue to suck capital into the U.S. And that's the good news for U.S. markets, that if you think of TINA, there is no alternative. There is right now no alternative to American exceptionalism in relative terms.
Mohamed, just to hang on the point of Europe, Robin Brooks of Brookings wrote a column yesterday basically saying Europe desperately needs a weaker euro, and now should be the moment where the ECB decouples from the Fed, where they cut, and they cut aggressively because they need some sort of stimulus that's not coming through governments in Europe. Would you agree with that?
A weaker euro would be like pushing on a string. What Europe needs is fundamental structural reforms. The Draghi report sets out the fundamental problem they have with productivity, with competitiveness. A weaker euro stimulus doesn't address those structural issues. So, Danny, I think it's much deeper than that. And I think that Europe has to understand that unless it takes serious steps, it will fall further behind. Unfortunately, the minute you say further step, you need political leadership, and we know what the situation is like in France. We know what it's like in Germany, and there is no European policy without France and Germany leading right now.
There is very little leadership, that's for sure. Mohamed, we're lucky to get some time with you. Appreciate it. Mohamed El-Erian there of Queen's College, Cambridge.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.